One obscure oil grade you have probably never heard of just jumped 633% in 7 days. Not WTI, not Brent. A crude called Mars. And what is happening to it right now is the single most important signal in global energy markets today. Welcome to Capital Anchor, where I cut through the noise and show you what is actually happening in markets while everyone else is distracted. If you are new here, I break down the stories the mainstream financial media glosses over. Subscribe right now, because what I am about to show you could completely reshape how you understand the Iran conflict and what it means for your wallet. Let me start with the number that should have been front-page news on March 6, 2026, but was buried under the general chaos of war coverage. Mars sour crude, the flagship heavy oil produced in the U.S. Gulf of Mexico, was trading at an $11 premium over WTI benchmark crude on Friday. That is the highest it has been since April 2020. And here is the part that stopped analysts cold. Just 1 week ago, that premium was $1.5. 7 days, $1.50 to $11. That is a 633% move on a single crude grade in 1 week. While everyone was watching Brent and WTI, the real signal was hiding in plain sight in the Gulf of Mexico. Brent itself settled at $92.69 a barrel on Friday, the highest since October 2023. WTI crude futures have surged roughly 37% in the same week. The national average for regular gasoline in America jumped to $3.32 a gallon, the highest level this year according to AAA data. This is no longer a geopolitical risk premium sitting in a trading terminal. This is hitting people at the pump right now. So what exactly happened? And why is a waterway most Americans could not point to on a map suddenly the most consequential piece of geography on the planet? Here is the event, the mechanism, and the reasons. Pay close attention, because each of these pieces connects. On February 28, 2026, the United States and Israel launched Operation Epic Fury, a coordinated strike campaign targeting Iran's military installations, nuclear sites, and senior leadership. Iran's supreme leader Ali Khamenei was killed in the strikes. Tehran's response was immediate and broad. Missile and drone barrages hit Israeli cities, U.S. military bases across the Gulf, and critical infrastructure in the way, Saudi Arabia, Qatar, Bahrain, and Kuwait. By March 2, a senior IRG commander officially confirmed that the Strait of Hormuz was closed. Any vessel attempting to pass would be targeted. Inbound vessel traffic through the strait, which had been 55 ships on February 26, dropped to 0 by March 4. At least 8 vessels were struck. Major shipping insurers withdrew coverage entirely for the waterway as of March 5, making the financial risk of transit impossible for commercial operators. The strait was not physically blocked with a chain. It was economically blockaded through the withdrawal of insurance, and the result was identical. Now here is the mechanism most people are completely missing. Think of the global oil market like a highway system with one tunnel that carries 20% of all traffic. Every other road still works. The traffic is still moving, but that one tunnel handles 20 million barrels of oil per day, roughly 20% of all seaborne oil trade in the world. When it closes, that traffic does not disappear. It has to go somewhere, and suddenly, every alternative road becomes extraordinarily valuable. That is exactly what is happening to U.S. Gulf crude right now. The Middle East refiners and Gulf nations who normally supply heavy sour crude to buyers across Asia and Europe cannot move their barrels. Iraq started shutting down operations at the Rumaila oil field, its biggest field, because tankers cannot leave and there is nowhere to store the oil. Kuwait has no alternative export infrastructure at all. It is 100% dependent on Hormuz. J.P. Morgan analysts warned in a research note this week that if tanker traffic remains blocked, Iraq and Kuwait face the following timeline. Iraq has roughly 3 days of export capacity before storage fills and production must halt. Kuwait has around 14 days. Combined crude supply losses could reach 3.3 million barrels per day by day 8 of the disruption. By day 15, that number grows to 3.8 million barrels per day. By day 18, it hits 4.7 million barrels per day. That is why buyers are running to U.S. Gulf crude like it is the last water in a desert. Mars sour crude, heavy Louisiana sweet, West Texas sour, all of them are getting bid up aggressively because they are physically accessible. The tunnel is closed, but the roads leading to the U.S. Gulf are wide open. Now let me give you the 3 Reasons this move is not a short-term blip. Reason number 1. The bypass infrastructure for Hormuz is catastrophically inadequate. Saudi Arabia has the East-West pipeline, which can handle up to 7 million barrels per day. The UAE has the Fujairah pipeline at 1.8 million barrels per day. Combined, these two bypass routes handle roughly 2.6 million barrels per day of additional capacity. The Strait of Hormuz moves 20 million barrels per day. Even maxing out every available pipeline, 2/3 of current Gulf crude exports remain physically dependent on the strait reopening. Iraq, Kuwait, and Qatar have zero comparable alternatives. Reason number 2. The war is not resolving quickly. President Trump stated on Monday that the conflict would continue for weeks and could become a prolonged engagement. Iran's governance structure, unlike some regimes, is institutionalized and decentralized. The URG does not dissolve because a leader is killed, Trump also stated. The U.S. Navy would begin escorting oil tankers through the Strait of Hormuz if necessary, which means the official position acknowledges the blockade is real and that normal commercial passage is not resuming on its own. Reason number 3. Iran pre-loaded its move. In the weeks before the strikes, Iran ramped oil exports to multi-year highs between February 15 and February 20. Iran increased exports to roughly 3 times its normal rate and reduced domestic storage. It knew what was coming and prepared accordingly. Those pre-exported barrels have already cleared storage. There is now no buffer. Any production disruption from Iran carries zero inventory cushion. Now here is the part that should make you genuinely angry if you are a retail investor watching this from the sidelines. While mainstream financial media spent the first 48 hours of this conflict obsessing over Brent and WTI headline numbers, the big round figures everyone tracks, the real institutional money was moving on the sour crude premiums, the Mars premium, the heavy grade spreads. Claypler, J.P. Morgan, Citigroup, and Rystad Energy were all circulating internal notes on the WTI Brent spread dynamics and the Mars premium from the first day. Saudi Arabia was quietly pre-positioning. In the weeks before the conflict, Saudi Arabia moved oil at what Claypler analysts described as a furious pace out of the Gulf, filling reserves in the Red Sea, the Netherlands, and South Africa. China had already amassed roughly 1 billion barrels of strategic petroleum reserves, about half its total storage capacity before the strikes happened. These are not random coincidences. These are institutions and sovereign governments reading the geopolitical calendar and moving billions of dollars in physical assets before the general public had any idea what was about to happen. Meanwhile, retail investors and everyday consumers were told about falling gas prices at the pump. The national average had dropped to levels not seen since 2021 in December, and were given no warning that oil prices had already risen 17% year-to-date before the strikes even began. The groundwork was being laid in plain sight, and no mainstream outlet connected the dots. But here is where it gets truly interesting, because the question of who benefits from this disruption, how long it can realistically last, and what happens to oil prices when it ends is something almost nobody is pricing correctly right now. Let me take you back to August 1990. Iraq invaded Kuwait within 48 hours. Brent crude jumped 28% in a single session. The world panicked. Headlines screamed about $100 oil, global recession, permanent supply destruction. But here is what actually happened. Within 6 months of the conflict ending, prices had retraced almost entirely. Supply came back. The premium evaporated. People who panic sold energy positions and panic bought at the peak paid the price. Now look at 2022. Russia invaded Ukraine on February 24th. Brent was at $96 before the invasion. Within 3 weeks it hit $139, a 45% surge. By June it was back below $115. By December it was under $80. The pattern is not new. Geopolitical shock creates a price spike. The spike price in the worst-case scenario. Then reality slowly arrives and the premium deflates unless the fundamentals underneath have permanently changed. That is the critical question right now. Is this a temporary shock or a permanent repricing of oil? 3 structural factors have not changed at all, and they will outlast this conflict regardless of how it resolves. First, global spare capacity was already thin before Operation Epic Fury launched. OPEC Plus had been managing production cuts since 2023. Saudi Arabia, Iraq, and the UAE together exported 13.1 million barrels per day via the Strait of Hormuz in 2025, with China as the main destination. Even if the strait reopens in 2 weeks, the political will inside OPEC Plus to flood markets and collapse prices is minimal. They built their national budgets around $75 to $80 oil. Second, China's pivot is now locked in. India and China face strong incentives to deepen reliance on Russian crude immediately, given proximity and established logistics. China, which had recently been moderating its intake of Russian crude, will likely abandon that restraint if the conflict extends beyond a few weeks. That is not temporary. Supply chain relationships built under crisis conditions tend to stick. Third, the insurance market has crossed a line it will not easily uncross. Before this conflict, war risk premiums were already at 6-year highs. They will not simply reset to pre-conflict levels once a ceasefire is announced. Institutional memory in insurance markets is long and unforgiving. Now, I am going on the record. Screenshot this. My prediction is Brent crude hits $100 per barrel before May 15, 2026. Here is why. Goldman Sachs raised its Q2 Brent baseline to $76 and explicitly models a $100 outcome if flows remain sharply curtailed for an additional 5 weeks. We are currently on day 7 of effective closure. That 5-week window begins now. Bank of America's Francisco Blanche stated a prolonged disruption in the strait could spike Brent prices by $40 to $80 per barrel above pre-conflict levels. Pre-conflict Brent was trading at $67. Add $40 to that, you are already at $107. The market is not pricing this in yet. The market is pricing in a quick resolution. But Trump himself said this will last weeks. That mismatch between expectation and duration is where the trade lives. Now let me give you 3 scenarios with probabilities, so you have a framework, not a guess. Scenario 1. The conflict ends within 2 to 3 weeks. Iran's new leadership reaches a backroom agreement. The strait reopens. Brent retraces towards $72 to $75. Probability 30%. Scenario 2. The conflict extends for 2 to 6 weeks. Insurance stays withdrawn. Iraq shuts down production partially. Brent reaches $95 to $105. Goldman Sachs and Barclays both model this as the base case if low exports via Hormuz persist for 5 additional weeks. Probability 50%. Scenario 3. Iran escalates into direct attacks on Saudi Aramco infrastructure. Saudi production is disrupted meaningfully. Brent surges above $120. Bank of America puts the upper range at $80 added to current prices if Iran takes a hard line targeting neighboring energy facilities. Probability 20%. Now let me talk directly to you depending on who you are watching this. If you are holding energy stocks or oil ETFs right now, do not chase the headline number. The first 7 to 10% of any geopolitical spike is usually the cleanest. You are past that. Manage your position size aggressively and set hard stops. This market will whipsaw violently on any ceasefire headline. If you are a trader using leverage, understand that news-driven markets punish leverage with speed. A single headline about Iran-US negotiations can drop Brent $8 in 4 minutes. That has already happened once this week. If you are levered long, cut size or step aside entirely until a direction confirms. If you are sitting on the sidelines with cash, this is not a moment to jump in blindly. Wait for one of 2 triggers. Either a confirmed strait reopening, which would be a buying dip in energy names, or a confirmed escalation that breaks $100, which would be a momentum entry with tight risk management. If you bought energy exposure before the conflict and are sitting on gains, the question is not should I sell it, is what is my plan if this retraces 30% in 48 hours when a ceasefire rumor drops. Have that answer before the market gives you the question. Now here is what you need to watch going forward for specific indicators. Watch Hormuz vessel traffic daily via Clapper's public vessel tracker. The moment tanker transits climb back above 10 per day, the premium will start deflating immediately. Watch the WTI Brent spread. The WTI Brent spread and the back end of the WTI curve represent the clearest near-term trading signal in this environment. A narrowing spread signals Middle Eastern supply returning. A widening spread signals continued disruption. Watch the Federal Reserve's language on inflation, persistently higher. Oil prices are threatening the interest rate policy of major central banks, including the Federal Reserve, as high energy prices fuel inflation and limit the scope for rate cuts in coming months. If the Fed pivots to a hold posture, risk assets will reprice broadly. Watch Iraq's Rumaila field status. If Iraq is forced to shut in production, that is not a temporary event. Restarting oil fields takes weeks and damages reservoirs. That is irreversible supply loss, not a disruption. Let me leave you with 3 types of people watching this right now. The first type is panicking. They are reading every headline, making emotional decisions, moving in and out of positions on noise. They will buy high and sell low. They always do. The second type is frozen. They know something big is happening but feel paralyzed because they do not understand the mechanism. They will miss both the opportunity and the risk management window. The third type is watching this video. They are learning the mechanism, building a framework, and making a plan before the market forces one on them. That is exactly the person this channel was built for. Here is the truth about markets that nobody wants to say plainly. Every major shock in history, every war, every supply crisis, every price spike transferred wealth from one group to another, from the unprepared to the prepared, from the emotional to the analytical, from the people who followed headlines to the people who understood the mechanism underneath. This moment is no different. About 20% of global oil consumption passes through the Strait of Hormuz. That number has not changed in 30 years. The risk was always there. The people who understood it are positioned. The people who did not are reacting. You started this video asking the same question I opened with. Why did one obscure oil grade nobody follows just jump 633% in a week while mainstream media was showing you the same round WTI number? Now you know. The tunnel is closed, and whoever owned the alternative roads was already ready. If this video helped you see what is actually happening, hit like right now and subscribe to Capital Anchor because this story is nowhere near finished. Send this to one person in your life who is confused about why gas prices are rising and has no framework to understand why. And drop one word in the comments right now. If you think the Strait reopens within 2 weeks, type short. If you think this runs to $100, type long. I read every single one. This is Capital Anchor. Stay prepared. This content is for informational and educational purposes only. It is not financial advice.